The problem is that the gold prices are very sensitive to a lot of different points. Like, it has a lot of idiosyncratic risks. Like, there may be the policy shifts that is going to affect the gold prices. There may be the geopolitical shocks. It's kind of the set of uncertainties, that different kinds of uncertainties that affect gold prices. So yeah, inflation is one of them, but there are mechanics of this is happening. Like, when there is inflation, it's a common thing that for the central banks to raise up the interest rates. And when that just happens because of inflation, the real yields are the yields that the bonds are giving, the coupon that the bonds are giving, after adjusting for inflation. If the real yields are very less because of the higher inflation, the people are going to just go for the gold. It's a non-yielding asset. It does not pay any coupons or dividends, but still they think that it is a better hedge in that kind of inflationary environment. But the gold has a lot of other sensitivity points, and if the gravity of those sensitivity points is becoming more, then there may be times, and this can happen, that the gold prices may move opposite to the direction of the inflation, or may just stay stagnant. And this actually happened in the year 1980s, like when there was hyperinflation, and the Fed actually raised the interest rate so high that the real yields are very attractive for the investors. So the investors got up to the bonds. The bonds is currently yielding, and the gold is not yielding, not giving the coupons in the meantime. So they better thought that the bonds is a very good investment at that point in time. So this is a phenomena which makes the gold not a better inflation hedge. It has its own supply dynamics that affect its prices. So that is a problem. So what can be a better inflation hedge? What I personally think that it is the commodities generally. Commodities are, because the one of the first and most common factor that led me to choose this thing is because the inflation actually passes through the price of commodities primarily. Yeah, inflation has the tendency to move in the prices of commodities like oil, gas, petrol, wheat, and yeah, these are the daily household items. And when they get expensive, the returns on the commodity is going to get up. So that's a common logic. But yeah, there are a lot of ETFs that actually invest in the commodities. And yeah, but the better choice is spot commodities, but it is kind of impractical to hold in real life, because there may be some soft commodities like wheat and oil which you cannot hold for long term. And these commodity ETFs actually are based on the futures contracts, and futures contracts, they are going to roll over each and every month, the short-term futures contracts, and that rollover actually makes a very bad effect on the returns, which is the negative roll yield, and which is something you can think of that is like, if the contract is going to end up at $50, and now you have to sell that contract and book up the profits. But now you have to buy the next contract maybe at $52, because the prices of the commodities are going up. So the forward prices are also up and above than the spot prices. So you have to get the next contract at $52. So you are just going to lose away the $2 in the meantime. So this is the thing that actually happens behind the closed doors in the commodity ETFs, which are actively traded on the exchanges. But it's still provided as a better inflation hedge against gold. But the gold actually makes a big part of these commodity ETFs also, because commodities is a generic and umbrella term. The gold is actually a part of the commodities. But the best thing about the commodities ETFs is that they are not primarily exposed to the idiosyncratic risks of the gold. Like, it does not constitute a very big proportion of those ETFs. So yeah, and historically the commodities actually proved to be a better inflation hedge during past recent inflationary periods. As you can see on the screen right now, gold actually not proved as a better hedge against commodities, because during some periods out of them the gold actually underperformed.